Let's bring in BondClick CEO Chris White for a closer look at Carvana's debt issues and who else may find themselves in a debt crunch soon. Chris, we've been saying that the debt has been telegraphing Carvana's troubles for some time. What do you think is next for this company based on what you see?
Yeah, I think the debt data around where Carvana's short-term and long-term debt has been basically pushing the company into distress territory. At least that's the opinion of bond investors. This is where I think stock investors and bond investors need to talk to each other a little bit more, because a little bit earlier you were talking about, maybe some of these stocks could become a value where you step in, but it's been pretty clear from Carvana's short-term debt that's maturing in 2025 that debt holders think this is a distressed asset, and so the stock should be continuing to fall as it has been throughout the year.
We also talk, Chris, about this notion about these pandemic darlings in particular that had sort of grown to the sky on the premise of the pandemic, and now some of that has to unwind. Are you seeing other Carvana-like companies, and I say Carvana-like meaning the debt is telegraphing real troubles ahead?
Yeah, like I just heard AMC mentioned, and I think that that's a perfect example of a stock that you're looking at right now. And since we're out of the pandemic period, what does AMC look like in terms of its future prospects? Well, we're looking at the short-term debt for AMC right now, and it's trading at 42 cents on the dollar. And what that means is that bond investors feel like it's highly unlikely that within the next 3 years that AMC is going to be able to pay off that debt, because we're at distressed levels here. So I think those are great indicators for any sort of equity investors as to whether or not they should be stepping in and buying something that's a value. What the debt is saying right now is AMC is absolutely not a value from a stock perspective.
Hey, Chris, it's Tim. How about talking about this particular pact that's been signed amongst the creditors? How, in your words or in your view, how unique of a moment is this? It's not particularly, but to the extent that you have the kind of concentration, maybe across different maturities of a group of investors, bondholders that actually can really dictate terms. Maybe at least we know where the debt's trading. It certainly implies something, but maybe while they can still be very tactical.
Yeah, I think it's obviously very bearish when some of the largest holders of the debt get together and say, hey, let's make sure that we don't sue each other if this company goes into bankruptcy. So that's really what the recent news has been regarding Carvana. The last time I was on, we were talking about duration risk. Now we're talking about credit risk. And these are two different types of risks in the market. I think you're going to have more stories like this Carvana situation coming into the market in 2023. And this is really a function of interest rates being lifted up quite quickly. And then these companies that have been borrowing at really cheap levels for quite a long amount of time, now finding that investors are demanding higher and higher yields, which obviously hurts their cap table and then damages their prospects in terms of future solvency.
So, Chris, when you look at companies like AMC or Carvana, people could say, oh, well, they had it coming. I could see that. That was going to happen. Is there a risk to companies that we don't see ripe for these type of events transpiring?
Yeah, this is where I think that corporate bond pricing has to be a part of the conversation of assessing the long-term health of an issuer. Because what you're looking at there is how the market is handicapping the future prospects. Do I think this company will be able to pay off their debt in 2 years, 3 years, 10 years, 20 years? If you really start to see in some of these growth stocks, major sell-offs in bonds that are 5 years and in, I think that's a really bearish signal on the stock. And I can't see a scenario where the stock recovers before the bonds. Obviously, in this situation with Carvana, the bondholders are senior to the equity holders, so they already have their knife and fork waiting for Carvana to potentially declare bankruptcy in order to figure out how they're going to be splitting up these assets. So given that the bonds are in this territory and other companies that you might see with their short-term debt in this territory, for me, I feel like it's a stay away from an equity investing standpoint.
Yeah, 5 years and under, rule of thumb. Chris, thank you. Always great to speak with you. Chris White of BondClick. Karen, you look at debt very often. So, I mean, when we talk about companies that have a lot of debt, that doesn't necessarily mean that they cannot service that debt.
Right.
There's a difference.
Yeah, so one of the things Tim talked about, when they have maturities, that's also important. And sometimes they have availability. They have, loans that they can take out, they can draw on. But when the business is losing so much cash, then it makes it really hard. And I've been short the HYG. It's moved a lot on rates, but we haven't seen that credit issue part of it really crack yet.
Yeah. Guy Adami.
What's up, Milms?
Hey, How's that computer behind you turned around? So you can't use it.
No, I mean, I'm looking.
Have you noticed that? Your thoughts on
here.
Carvana and what's next? I mean, we talk often about these companies that have heavy debt loads, like a cruise lines, and we're not trying to single out any company and saying that they're the next Carvana, not at all. But these are all concerns in a rising interest rate environment.
So many of these companies fashion themselves as new technology companies, basically reinventing the wheel. Danny Moses came on the show earlier in the spring when Carvana was $160 and said, probably the best short on the board. That proved to be correct each and every day since. But, look at a couple other names. Look at Affirm. Look where that stock was trading basically this time last year. Throw a chart up of Affirm and look at Upstart, too. Upstart was a $400 stock in October of last year. I think it's trading $16 now. I mean, they really haven't reinvented anything. I mean, they're just lending facilities, and if they can't sell their loans to Wall Street and they're forced to put them on their balance sheet, they can no longer originate loans, and these loans, their balance sheet deteriorates, and that's what you're seeing right before your very eyes. And when you think you've reinvented something, the reality is this is just a spin on a very old product, and I think we're seeing it happen here in those names specifically.